I'm Kevin Price. This is my Price Point edition. I do want to remind you to check me out over there at priceofbusiness.com and usdailyreview.com. Priceofbusiness.com is the web home for the Price of Business show on Business Talk 1110 a.m. I want to talk a little bit about the trade deficit. I just saw recently where news reports were pointing out the fact that our more robust economy, let's face it, it is a little better than it was a couple of years ago, is lining up at the same time with an increase in the trade deficit. And all of a sudden people are befuddled by that. They're scratching their head. They can't figure it out. And the reason why is people don't think consequentially. That's kind of my theme these days. Let me kind of give you a little bit of perspective, a little bit of history. Back in 1928, there was a presidential race where Herbert Hoover, running for president of the United States, he was doing extremely well in all of the polls. He was following one of the most successful administrations in U.S. history, that of Calvin Coolidge. And he was Calvin Coolidge's Secretary of Commerce. And things were going extremely well going into that 1928 election. The number of people who made over $100,000 a year, which, let me tell you, back in the 1920s, that was a lot of money, quadrupled in the years of Calvin Coolidge as president. Quadrupled is unbelievable in terms of kind of financial growth. Unemployment, less than 1%. Inflation, less than 1%. It was called the Roaring Twenties, not only because of the fashion style, but because of an incredibly robust economy. So in 1928, you got Herbert Hoover running for president, running on as someone associated with Calvin Coolidge and saying, look at this phenomenal economy we produce. It's a no-brainer to elect me president of the United States. Well, it was looking pretty good all along, but his opponent kept on pointing out the fact that in spite of all these great economic statistics, there was one area that the federal government was doing poorly in, and that was in a trade deficit. The United States had a massive trade deficit in 1928, and this was being pointed out by Hoover's opponents as a weakness in the economy, a weakness that he, as Secretary of Commerce, actually oversaw, making him responsible for this apparent weakness in the economy, this trade deficit. Well, that made Herbert Hoover a little nervous as they approached November of 1928, and he announced that no matter who got elected, you could support my opponent or you could support me. He said, we are going to have tariffs that will address our trade deficit issue. I'll support trade deficits as president of the United States. He made that one of his promises near the end of 1928. And so he gets elected in 1928 by a huge margin. And two members of Congress named Smoot and Hawley developed a tariff bill called the Smoot-Hawley Tariff Act of 1929, and it went through Congress slowly but surely. The President Hoover now said, yes, I'll sign it if it makes it to law. And then in the early fall of 1929, it became apparent that it was going to become law. And then in October of 1929, you saw an article on the front page of the New York Times saying, Smoot-Hawley Act will be passing, and then on the top of the page it says stock market sells 16 million shares in one day. And so what happened? What was is there a correlation between the two? Well, economists warned Hoover that if they supported the Smoot-Hawley Tariff Act, it would lead to a collapse of the U.S. economy, or at the very least a pounding on it, and could actually create the foundation for a depression. Boy, were they right about that. Of course, Hoover oversaw the biggest depression in U.S. economic history. Now, how is that? The reason why is that whenever there are goods and services and there's tariffs that go up, people on Wall Street have enough sense to know that businesses and that countries, foreign countries that are facing tariffs, will retaliate with their own tariffs, which means the values of all goods, particularly on an international perspective, would begin to decline. It would begin to suffer. The reality is the United States had a huge trade deficit in 1928 because it had huge economic wealth. It could afford to buy more than any other country in the world. Ironically, by 1931, the United States had its biggest trade surplus in its history after the Smoot-Hawley Tariff Act, and we had over 18% unemployment. Why did we have low trade deficit, or actually no trade deficit, a surplus? It's because we couldn't afford to buy foreign goods anymore. Do we really want to be in an economic situation that we protect our trade surplus situation by not being able to afford to buy goods from other countries? I can't imagine that's a logical objective for those in government. But that's what we hear all the time in defense of tariff-type legislation. Tariffs lead to depressions. We saw that in the Great Depression. And I get worried about it every time that rhetoric is out there again. Again, it goes back to thinking consequentially. Consequentially thinking we want as few tariffs and as few barriers between us and other countries because we want to freely get their goods, which help benefit our consumers, and equally important, we want to freely send our goods to other countries. They knew on Wall Street that that barrier would create walls internationally and that it would devalue the value of stock. That's what set that fuse. Make matters worse, within a matter of a few years, we had World War II break loose, which part of the reason for World War II was because of the negative international consequences of the Great Depression that may have began with a simple tariff act. That's my perspective. I'd love to get yours. Make sure you email your thoughts to info@usdailyreview.com. This is my Price Point Edition.